All right, so in this video, I'm going to walk through the difference between tax credits and tax deductions. Those are two different terms. They have a different impact on your personal return as well as your business. In this video, I'm going to just focus on personal returns. You know, the IRS has just opened up their portal as of Monday this week where you can start e-filing your returns. And I'm not sure that individuals really understand the difference between deductions and credits. So I'm going to do a high-level walkthrough, and I'm going to utilize a tax return to kind of show you the different parts of the return and the impact on having certain deductions versus credits. And you know, the long story short is whenever you hear a tax credit, that's a lot better than a tax deduction. Tax deductions are not bad things. They're also good, but they have a different impact on your tax liability and your personal return. So if you have any questions, let me know. Thanks again for watching.
Okay, so we're going to walk through a 2023 tax return. And the whole purpose of this video, again, is showing you the difference between tax deductions and tax credits. Both are great. One's better than the other. And the whole, thesis here is for you to understand and kind of look out for, and like when you read in the paper online, oh, there's a tax deduction out there, or there's a tax credit. Just make sure that you're getting an opportunity here, and you're taking advantage of those. I'm not going to go through every credit. There's tons of tax deductions. There's tons of tax credits. I just want to show you on a personal tax return how those deductions and how those credits impact what you owe or what you could get back from the IRS. So in this example, we have a couple, they're married and they have 2 kids. Okay. So the first off is we're going to calculate what their income is, right? So there's various different sources that people earn income. In this example, they receive 2 W-2s. The total of those equal $220,000. So as you get your W-2s in the mail, that box number 1, that is your income, right? Your wage that you got from your employer. Then we kind of skip down here. We got taxable interest, right? So they got money sitting in a bank earning interest income. And with these high savings rates, we're seeing a lot of our clients have really high numbers up here because, the rates in the banks are, 5%, 6%, and they're just, making a lot of money here, a lot of passive income. So that's taxable. Okay. And then dividends, right? So think of stocks that, will give out dividends, every quarter. Think of like Apple stock, right? They're a dividend, company where they, issue dividends to their shareholders, and that's taxable, right? And you may not actually get the cash, but you still got to pay tax on it. And I can tell you, and I'll mention this many times in this video, is tax planning, because if you don't look out for this, you're going to be stuck with a tax bill at the end of the year. And, these amounts here are kind of small, but we've seen larger amounts. And, the whole purpose of tax planning is to kind of look out for this, see what you can do before the end of the year. So we got this, and then you got capital gain or loss. So think of like you bought stock. Let's take Apple, for example. You buy it at X and you sell it for Y. And the difference between the two is going to be a gain, right? You made money, or a loss, you lost money. This example, they had a gain of $8,200. So they sold it during the year, they got the cash, now they got to pay the tax on it. So you add all this up and you get to your total income, okay? And if there's any adjustments, that will kind of reduce it. But in a, very simple, family or even a single person, this is typically what it looks like. So you arrive at your adjusted gross income. Now we kind of look at like deductions, right? So if there are no deductions, which is never the case, this is the amount of, this is how the tax is going to be calculated off of. Okay. But now we want to look for some deductions here. So you can take the standard or you can itemize. In this example, this couple is going to itemize because it's higher than the standard deduction. I'm going to jump to the Schedule 8, and then I'm going to remove a number. So just remember this 32,500. So the itemize is higher than the standard deduction in this case. most people, if you don't own a home, you're going to take the standard deduction because the standard deduction is higher. For married file joint, the standard deduction is $27,700 in 2023, I believe. So in this case, the standard is higher, so they're going to take that. So let's go jump to Schedule A here, and this is the summary of deductions here. So first off, taxes that you paid. So they paid state taxes, and they paid some real estate taxes. Now, back in the day, you could take, $20,000, right? The sum of those two. But, it was 6 years ago or so, they changed the tax law and they capped this at $10,000. And this has been a hot topic with a lot of people in Congress to reduce, eliminate this cap or increase the cap, right? So instead of it being $10,000, maybe make it $40,000. So in this case, 6 or 7 years ago, this couple, they were able to deduct the $20,000. But with this cap, they're limited at $10,000. The next deduction here is the mortgage interest. So it's not principal that you pay your bank, it's the interest component. And your bank is going to send you like a year-end tax form that shows, here's the amount of interest that you paid during the year. And you get to deduct that, right? So now we're at $10,000 plus the 15, so now we're at $25,000. Another big deduction is when you donate to charities, right? So if it's a charitable organization, 501c3 listed on the IRS website, the amount that you donate to those charities, you can deduct that. So that's another deduction. So when you see all this, it adds up to $32,500. And that's what, they get to deduct. Now let's change this a little bit and just say they didn't own a home. And I'm going to show you the standard deduction here. Go back to page 1, and you can see here now the standard deduction is showing up here, right? Because before the itemized was higher because they owned a home, they paid mortgage interest, and that when you add all those up, that was higher than the standard deduction. So, and everyone gets one, right? So single, you get one. It's a lot less than those that are married. Head of household, you get a standard deduction. And what this does is it's reducing your total income. Because whatever your income is, your taxable income, that's what is used to calculate what your tax is and what you owe the IRS. And we're on a tiered system. I'll probably create like a separate video later on this. But, a lot of people kind of look at like, oh, my taxable income is this. Let's go to the tax rates. Oh, I fall in this range. Let's take this times that percentage. And that's not the case. That'd be more of like a, flat tax rate. But we're on a tiered system. And again, I'll create a video on how all that works. But, so in this case, we'll keep the standard deduction. So their taxable income is $205,000. Now, next up, we go to page 2 of the 1040 and we get to now, we can kind of calculate what their tax is. So in this case, their tax is $35,382. That's what they owe the IRS. Okay. But wait, there's credits. Tax credits are better than deductions because tax credits will reduce the amount that you owe the IRS. Okay. Now let's go back to the deductions here. Deductions reduce your total income to come up with your taxable income, which is used to kind of calculate what your tax is. Credits reduce your tax. So whenever you hear like a tax credit out there, like, and I'm going to go through a couple here, your ears should kind of light up and you want to make sure you're taking advantage of this. Again, this goes back to tax planning because once the year end closes, right? So we're in January here, or this video is probably going to launch, I think February 1st here. It's too late to make any changes to 2023. So tax planning. So the first one that, a lot of people, have heard of is the child tax credit. In this case, it's $4,000. There's a schedule here. There's another tax form that kind of calculates it. And, there's a phase out, right? So if you earn over a certain amount, that credit gets reduced. But here they have 2 kids, and their total income is below that threshold. So they're allowed to get the tax credit of $2,000 per child. Again, if your income is over this amount, the $400,000, that $4,000 credit is going to get phased down, okay, very fast. So this is a nice credit, right? You got children, every child's worth, $2,000 here in this example. So that's a big one. Next up here is additional credits, right? This line 20 here. And I'm going to show you this. So amount from Schedule 3, okay? So Schedule 3, line 8. So that's $4,300. I'll show you what makes up that amount. When you add these two amounts here, you get $8,300. And instead of paying the IRS $35,000, now we're down to paying the IRS $27,000, okay? Then there's some additional taxes, which I'll go over. You got to add that back. Now you arrive at your total tax. So we started at $35,000. Now we're down to $31,000. Okay. Again, I'm going to go back to these credits here. Then we kind of look at your W-2s. And as you could imagine with your paychecks are a lot less than if you were to take your gross salary and divide it by 12 months, divided by, 2, if you get paid every 2 weeks. It's because your employer is taking taxes out and they're remitting it to the IRS on your behalf. So in your W-2, box 2 shows you how much you've paid into the system already. So in this case, this couple combined paid $34,000. So they owe $31,000. They've paid $34,000. So they're now in a refund position, right? Because they've paid over what they owe. And then this line number 26 here, I just put in an amount because they made a quarterly tax estimate. So this is big for business owners out there. If you're profitable, you should be making quarterly tax estimates. And that's what this is right here. And then, so you add the 34 plus the 4, you get 38,700. Here's what they owe. Here's what they paid in. The difference between the two is kind of a refund. Now, there's one thing I kind of skipped over here is there's another big deduction. It's called the qualified business income tax deduction. And that's this line right here. This could be up to 20% of net income of your business. So we're talking about S Corp owners here. We're talking about LLCs, single member LLCs, right? You run a business, it's profitable. That income from that business is going to show up on line 8 here. But so then that's going to increase your total income. But then there's a deduction on that of up to 20%. Now it's a detailed calculation, but you don't want to miss out on it. Okay. QBI is also another name. So qualified business income, QBI. But you don't want to miss out on that. Now let's go back to that other credits here. Schedule 3, line 8. So we'll go to Schedule 3 of your tax return, and all your tax returns are going to look just like this. Here's some additional credits, right? So another one, right? Energy efficient home improvement credit, okay? Putting in new windows, right? Putting in new doors, right? This credit, there's a cap on it, there's a limit, and it all depends on what you bought, but that's a credit, okay? And again, that helps reduce the tax that you owe the IRS. Another big one, the clean vehicle credit. Okay, so these are, you think of your Teslas out there, right? But you got to be careful on how this is calculated, because in 2023 here, the rules have changed from 2022, and you got to look at your AGI. There's a lot of different components. I just plug this number in here just to make sure that you understand that that's a credit and how the credit kind of works. There's the credit for dependent care, right? So think of child care, right? You have a nanny watching your children are in daycare, they're at school, right? Depending on what the cost is. So in this example I used, so let's go to form 2441. They spent $20,000 in childcare this year. Okay. That's a lot. for their kid. And there's a calculation here on how much they can get in credits. You can see here it's very minimal. So it's $600. Now $600 of credits is better than nothing, but for the amount of money that they spent here at daycare, and they're only getting $600 in tax credits, it's small, but you don't want to miss out on it. And again, there's a phase out, and based on your income and everything. So that's that credit. So we got that one, we got this one. I'm covering like some big credits here. If you want to see a video on what are other credits, leave them in the comments below and I'll be happy to create one. So here's the clean vehicle credit. So the sum of all those will get to that $4,300. Now let's get to the last item here is additional taxes. Okay. This is where like self-employment tax will show up. So you own a business, an LLC, a partnership, a single member LLC, sole proprietor, you're profitable. It's going to be subject to self-employment tax, and that's going to show up here. In this example, I want to do a call out, in this case, this couple, they hired a nanny and they paid that nanny through a payroll service. Okay. And when you do that, you fill out the Schedule H. Okay. And in this case, they paid the nanny $10,000. There were taxes withheld, Social Security tax and all that. But when you do all this, it's a tax to you. Okay. And that's going to show up, that's another tax. And this is why there's people that have nannies or in-house care and they pay them in cash because of this reason. I mean, this is one of the reasons. The right way to do it, if you truly have a nanny or someone, you got to put them through payroll. But in this case, that's what they did. And that's why a lot of people kind of pay in cash. So, let me know if you have any questions on this video. Again, the whole purpose is to kind of show the difference between a deduction and a credit, and you should be aware of the two. Again, leave the comments below. Thanks again for watching.